So what I want to do is a continuation off of Snow. Now, this can be related to any stock that you believe in and that you feel has long-term potential. A stock that has maybe been beaten down and you feel that has some major room to run. So that's kind of the thesis. And then what you're taking a look at is thinking, how do I go ahead and get involved in this particular stock? And again, it can be any stock that you believe in. How do I get involved in this stock and then be able to have the market finance a portion of it or finance the entire trade? And that way it's a risk off trade. Here's what I want to show you. So we take Snow, for instance, and we're looking at going out till the Jan 24s. And we look at and we say, okay, this thing has the potential of run into, what do we say? At least over $300 a share at some point. So we're giving it plenty of room to run based off the formation that we see. And we take a look, we don't go too far of the money, although we could go a little bit further out, but we take a look at go in with the 200s, giving it a chance where it can move into intrinsic value fairly quickly. So we're looking at the Jan 2024, 616 days till expiration. We're paying between $39.30 and $41.20 for the trade. That means that our break even is about $241, maybe a little bit less, $240. So if it got to our 300, as we stated before, we would have $100 of intrinsic value in this particular option, which means we would have more than a double. But what do we do in the meantime? Do we just sit here and wait for the stock to move? Or do we go ahead and look and enter this trade with the idea of being able to put money back in our pocket and at some point have the market finance the entire trade? So take a look at this. We're all the way out until Jan 2024. And we can see that we can look at these shorter term options as well if we wanted to. We could take a look and see if it makes sense to do the shorter term options. You know, maybe even do like the 180s, selling the 180s. So we're selling and you're trying to be strategic about it. And that's where you have to know the stock's ATR, the average trading range, what it moves. And say, okay, I got 14 days to expiration. The stock's at 155. Can it make it to 180 by that expiration date? I mean, it could, but when we take a look at the market, we take a look at, here it is again, hitting that resistance area that I had talked about in the previous video. And it's struggling to break above that. At some point it will, but will it happen now? Chances are it won't. But we look at that and if we wanted to, we could start to say, let's take $6 off of our trade by being able to sell the 180s on this. And then as you go along, so all of a sudden, $6 comes off of that entire trade, which we paid $40 for. So if we look at this from a mathematical standpoint, if we look at this, we would be looking at, if you take $40 a share, and you're dividing that by, let's say you get $5 or $6 each time, let's divide it by $6, you would have to go ahead and do a similar transaction about 6 times. 6 times of being able to sell an option, you would be able to go ahead and within 6 times, you'd be able to go ahead and pay that entire trade. So if you collect at $6 each time, $6, 6 times 6, well, that's $36. So maybe 7 times, you would have, that would be $42, and you paid about $40 a share for it. That would be incredible to be able to do that. Because then by the time you get maybe into your last 45 days of expiration, maybe even sooner, you would have that entire trade paid for, and this would all be profit. So there's times that I like to enter trades with the mindset of being able to say, I believe in the trade. I'm looking for this thing to double or more and increase in value. But at the same time, I want to take as much of my original investment off the table. So you could do that by, again, there's many different, if you take a look at all the different options that you have available, we're all the way out here. Look at all this. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. You have 12 times, 13 if you count this one, and they'll probably add more as we get close here, but you have 12 to 13 times that you could go ahead and sell some type of an option and bring in some type of money into this trade. So here you have 7 days left, right? So you could choose, if you chose the 180s, you would bring in less on that. So I probably wouldn't do the one that had 7 days left on it. I might do the one that I just showed you that had 14 days left. You could do the 180s here and bring in $6 on that trade. You could go ahead and do the Junes, the monthlies, and you have to take a look and examine which one you want to take a look at. If we did this one has 35 days, would I do this one? I don't know if I'd do the 180s at 35 days. You'd bring in $10 though. I might consider doing the 200. But if I was going to do this and bring in 5, I think I'd rather do this one has 14 days left, sell the 180s and bring in 6, and then see where the stock is. See where the stock is the next time around, then do the Junes, and then the next weeklies, and then the next one, and so on. Until, again, the ultimate goal, if you're averaging about $6 each time, you're looking at 6 to 7 times, you'll have this entire trade paid for. So those are the things that you want to take a look at and doing when you're thinking about it as a trader. You also want to think not just directional, but you want to think from a strategic point of view. What can you do? What can you do to reduce your risk and increase your profits even more? Hopefully that helps.